The Canadian economy rarely moves in sudden collapses. It erodes in increments, job by job, contract by contract, plant by plant, until the structural damage becomes undeniable. This week, the signals were no longer subtle. General Motors announced the layoff of 500 workers in Oshawa. The White House escalated threats aimed directly at Canada's aerospace sector, an industry deeply embedded in continental supply chains. Statistics Canada confirmed what many executives and policymakers had privately feared: gross domestic product contracted in the fourth quarter. This is not a cyclical slowdown. It is the visible front edge of a strategic dislocation. Canada's post-war economic model was built on integration with the United States, an industrial, energy, and trade architecture designed for proximity, scale, and reliability. That architecture is now under stress. Ottawa's answer is diversification, new markets, new partners, internal trade liberalization, and a $1 trillion investment push over 5 years. The political messaging is ambitious. The strategic timeline is not. If you value this kind of high-level analysis, where economic headlines are treated as signals of power shifts rather than isolated events, subscribe, share this analysis, and engage with the channel. Understanding the mechanics of these transitions is no longer academic. It is strategic intelligence for a country navigating an economic realignment in real time. Consider the auto sector, historically one of Canada's industrial pillars. It has been among the most exposed casualties of the current trade conflict. Thousands of jobs lost. Production shifts idled. Windsor recorded the highest unemployment rate in the country. Ontario's Financial Accountability Officer documented a historic inflection point. Manufacturing employment fell below 10% of total provincial employment for the first time since records began in 1976. That statistic is not merely descriptive. It is diagnostic. It marks the steady hollowing of Canada's industrial base, a trend now accelerated by geopolitical friction. Ottawa's diversification narrative seeks to project momentum. A memorandum of understanding with South Korea was announced, with language implying the possibility of a Korean automotive footprint in Canada. The symbolism was deliberate. Korea represents advanced manufacturing, global supply chains, and potential decoupling from American dependence. Government statements framed Canada as an enduring auto nation, promising strategic investments to protect jobs and strengthen the sector. But corporate reality diverged from political optics. Hyundai, the implied anchor of the announcement, clarified that no vehicle manufacturing operations are planned in Canada. Instead, the company pointed to exploratory cooperation, including hydrogen energy. This is a critical distinction. A domestic assembly plant anchors supply chains, labor markets, and capital investment. Hydrogen collaboration is research-oriented, capital-light, and dependent on infrastructure that does not yet exist. The gap between rhetoric and industrial commitment exposes a structural problem. Diversification is not simply a trade policy choice. It is a capital allocation problem, an infrastructure problem, and a corporate strategy problem. Governments can sign memoranda. Firms decide where to deploy billions in irreversible assets. At present, Canada does not present a compelling case for rapid automotive reinvestment. The Bank of Canada's assessment is blunt. Firms are attempting to diversify, but the shift will be gradual, costly, and constrained by existing trade channels. RBC's Claire Fan identifies the dividing line. Companies already exporting beyond the United States could pivot. Those without established channels were left behind. This is path dependence in action. Economic geography, logistics, and historical relationships define who can adapt and who cannot. This dynamic reveals the deeper vulnerability. Canada's integration with the United States created efficiency, but also dependency. Diversification is not merely about signing agreements with new partners. It is about rebuilding logistical and commercial architecture from scratch. Infrastructure becomes the choke point. Tracy Robinson of CN Rail framed the challenge succinctly. Expanding trade requires expanding supply chains. Ports, terminals, rail capacity. Each is a multi-year project, subject to regulatory bottlenecks and political contestation. The Trans Mountain Pipeline expansion serves as a cautionary case study. 14 years from approval to completion, with ballooning costs and federal ownership to force completion. That timeline is incompatible with the immediacy of current economic pressure. Sean Strickland of Canada's Building Trades Unions illustrated the permitting paralysis. 4 years of approvals for 4 months of dredging. This is not a minor bureaucratic detail. It is the structural constraint that makes diversification aspirational rather than operational. The strategic question, therefore, is not whether Canada can diversify. It is whether diversification can occur at a speed and scale sufficient to offset the immediate contraction of its U.S.-oriented industrial base. Canada's diversification strategy is framed as an economic necessity. In practice, it is a geopolitical adaptation forced by deteriorating certainty in the U.S. relationship. For decades, Canadian policymakers assumed the United States would remain a predictable anchor market. That assumption is now invalid. Trade wars, industrial policy, and national security-driven tariffs have transformed North American integration into a contested domain. The auto sector exemplifies the structural lag between strategy and execution. A memorandum of understanding with South Korea is symbolically important but materially insufficient. No Korean automaker is committing to Canadian production. Hydrogen collaboration, while technologically significant, does not replace the employment and supply chain density of internal combustion or electric vehicle manufacturing. Without assembly plants, Canada remains a peripheral node rather than a core manufacturing hub. The Bank of Canada's survey data underscores a two-tier economy. Firms with pre-existing global exposure can pivot exports. Those embedded solely in U.S.-centric supply chains cannot. This bifurcation will widen regional and sectoral disparities. Windsor's unemployment spike is an early indicator of how localized industrial dependency translates into social and political stress. Infrastructure is the decisive variable. Trade diversification is infrastructure intensive by definition. Ports must handle larger volumes and new routes. Rail networks must shift from north-south integration toward east-west and trans-Pacific flows. Pipelines and energy corridors must align with global demand rather than U.S. consumption patterns. Each requires regulatory reform, capital mobilization, and political consensus. Canada's track record suggests slow progress and escalating costs. The Trans Mountain expansion illustrates how strategic infrastructure becomes politically contested. Federal ownership was required to complete the project, transforming the government into both regulator and operator. That dual role is not scalable across multiple sectors. If diversification requires a portfolio of similar interventions, the fiscal and administrative burden will be unprecedented. The permitting example provided by Canada's building trades unions highlights a deeper governance challenge. Environmental assessment, Indigenous consultation, and multi-level jurisdictional approvals are essential for legitimacy. However, their current sequencing and timelines are incompatible with rapid economic adaptation. The result is a structural mismatch between democratic process and global market velocity. From a strategic perspective, diversification is constrained by three time horizons: short-term, job losses, GDP contraction, and immediate market volatility. Medium-term, infrastructure build-out, supply chain reconfiguration, and corporate investment decisions. Long-term, reorientation of Canada's economic geography and trade identity. Policymakers are promising long-term transformation to solve short-term crises. Markets will not wait. The trillion-dollar investment narrative is politically powerful, but operationally ambiguous. Investment requires private capital alignment, regulatory clarity, and competitive returns. Without structural reform, public announcements risk becoming signaling devices rather than catalysts. The Canadian economy stands at an inflection point defined less by recessionary cycles and more by strategic realignment. Diversification is necessary. The question is whether Canada's political economy can execute it under pressure. The divergence between government optimism and corporate caution is a recurring theme. Hyundai's statement is emblematic. Cooperation without manufacturing. This pattern may replicate across sectors. Foreign firms may collaborate on research, pilot projects, and niche technologies without committing to large-scale production. Such engagement generates headlines but not mass employment. The firms that succeed in diversification will be those with legacy global integration. This implies a Darwinian restructuring of Canada's corporate landscape. Export-capable multinationals will adapt. Domestic-focused firms will contract or consolidate. Regional disparities will intensify, with industrial hubs experiencing sharper labor market shocks. Infrastructure remains the critical path dependency. Without accelerated permitting and capital mobilization, diversification timelines will stretch beyond political mandates. The Trans Mountain experience demonstrates that strategic projects can be completed, but at high political and financial cost. Replicating that model across ports, rail, and energy would require a redefinition of federal and provincial roles. The underlying strategic risk is temporal. Economic damage is immediate. Structural transformation is slow. This creates a policy gap where unemployment rises, GDP contracts, and political pressure escalates before diversification yields tangible benefits. In that gap, populism, protectionism, and policy volatility become more likely, further complicating long-term investment. Canada's diversification narrative is strategically correct but operationally fragile. It requires a level of state capacity, regulatory reform, and capital coordination that Canada has historically struggled to deliver quickly. The winners will be firms and regions with pre-existing global connectivity. The losers will be those embedded in legacy North American supply chains without alternative routes. This is not merely an economic story. It is a power transition within Canada's political economy, where the ability to build infrastructure, attract capital, and navigate geopolitical realignment will define national competitiveness for decades. The outcome is not predetermined, but the window for decisive action is narrow, and the cost of delay is already measurable in layoffs, idle shifts, and contracting GDP.